from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
And I'm Taylor Riggs in for Emily Chang. This is Bloomberg Technology. Coming up in the next hour, sales growth slowdown and high-level departures. That's what Salesforce is dealing with all at the year's end. We discuss why this is impacting its MuleSoft sector. Plus, just shy of $3 trillion, that's where Apple closed the day. We break down the company's biggest weekly gain since July 2020. And Bitcoin posting its fourth consecutive weekly decline. This after a brief bounce earlier this week. We'll get to all of that in a moment, but first, let's take a look at, where the markets ended up closing. U.S. stocks rose to a record on Friday after, inline inflation data continued to spur bets that the Fed won't have to accelerate plans to tighten monetary policy. The Fed, of course. And Bloomberg's Kriti Gupta here to break it down for us. And Kriti, pretty much in line, and the market liked it?
Absolutely. CPI 6.8% year over year, bang in line with estimates. And although that seems like a very big number, at the end of the day, we've had bigger surprises. So going into this CPI report, there was this kind of built-in expectation that CPI would surprise to the upside, and then it didn't. And that's really where you saw stocks kind of breathe the sigh of relief. But remember, we also have volume lower by about 12% down from its daily average. Nevertheless, pushing the S&P 500 and Apple, I should say, both to all-time highs. And that's what I'm showing over here. I also want to point out the 10-year yield down 1 basis point. Once again, a sigh of relief in the stock market, a little bit of a bid for the bond market. Let's just take a look at another piece of data, though, inside my terminal. Not the CPI print, but the other piece of data we got, which is real average hourly earnings and weekly earnings, which is also a crucial piece because as we see inflation get higher and higher, wages just aren't keeping up. And that's really what this kind of red cluster shows on the right side of the chart. This idea here that wages are actually declining. It means that your paycheck just isn't worth as much. The question here is, does that lead to strikes, to unions, or to better wages is the hope. And I'll end here with our next slide, which of course is the Information Technology Index versus the S&P 500, because Taylor, that was the leading sector today thanks to blowout earnings from both Oracle and Broadcom. Now the information technology making up almost a third of the entire S&P 500 in terms of weighting.
Really appreciate your time and that wrap up. Kriti Gupta, thank you as always. And of course, we continue to talk about inflation. It always comes back to supply chain issues, and they continue to impact sort of this holiday shopping season that we're still in. Let's do it all with Bloomberg's Ed Ludlow, who's out there at the Port of Los Angeles to give us the latest, and who also told me he hasn't done his Christmas shopping yet, which means you're in big trouble.
I'm in big trouble because the data tells us that the backlog is still severe. There are almost 100 ships out in the San Pedro Bay, even beyond that, up to 150 miles out into the Pacific, waiting to come into this port. And they're waiting on average for 3 weeks. Just to give you an idea, Taylor, it takes 3 weeks to come from China to the west coast of the United States anyway. So when they do eventually arrive, they're waiting an extra 3 weeks. And all of that means that that supply, that inventory, it's in the containers behind me and it's not making its way to shelves. Worrying during the holiday season, but really one of the big themes of the day was technology, or a lack of. What's going on behind me, what you see over my shoulder, is very manual, taking containers off of a ship, putting them onto a truck, and the truck drives them away. It does require some sophisticated cranes, but beyond that, it's a very human process, and that's where the shortfall appears to be.
And Ed, we've been talking a lot about this with the last 3 months, where it looked like there was improvement. Is there, or are we just getting better at calculating the ships that we want to count and ignoring the ships that are further out that we aren't putting in our statistics?
This is good old-fashioned economics, right, Taylor? Supply and demand. The thing that's not changing is the demand. The way the port's executive director, Gene Soroka, describes this, you're trying to fit 10 lanes worth of traffic, worth of material into just 5 lanes of space. And This is what the story of the pandemic has been for the consumer. At a time where we were at home, we were spending our money on goods, not services. We were buying physical objects. Now there's a backlog that we're trying to work our way through during a holiday season where e-commerce has been at the center. Remember, we're still in that key shopping period, even though we've had Black Friday, Cyber Monday. So more material is coming in, the demand is not changing, and they're playing catch up. The problem is that the coronavirus still is disrupting that. Every time a longshoreman falls ill, a truck driver contracts COVID-19, it's disrupted to how efficiently they can move goods through this port.
You know, Ned, we just have about a minute left, but I am curious what the political conversations have been like. Have things improved with the Biden administration all in and talking about this?
Yeah. What's amazing about the port complex is it's a many-tentacled beast, and all of the tentacles have a different opinion. The truck drivers, the longshoremen, the port authorities. The only thing they agree on is that the Biden administration has, for the first time ever, brought all of them, sat them down and got them talking about data, sharing information about how we can fix this supply chain long-term. Just very quickly, when a truck driver arrives here at the port, he gets given a ticket. The ticket tells him which containers to go and pick up, and he waits there until it's ready. I think a lot of people are calling for a better system that is technology first.
Bloomberg's Ed Ludlow, go scram. Go get what's left on those holiday shopping list. Ed, get out of here. Thank you so much there for your time. We want to pivot and also talk about Salesforce because they've been grappling with the sales growth slowdown and a wave of some high-level departures over at MuleSoft. The move is raising concerns that the business won't continue to produce the gains it has generated since the software maker bought the company for about $5.6 billion in 2018. Bloomberg's Joe Williams joins us now to discuss. And Joe, I am curious about how you think about MuleSoft in a broader context of what is Salesforce.
Yeah, so MuleSoft is definitely the most complicated product that Salesforce sells. But when you think about Salesforce's future ambitions, it really is a critical part. Right now or historically, Salesforce's applications operated largely isolated from one another. And customers are increasingly wanting software to work with each other. They want to automate processes, and to do that, you have to touch every bit of software in the process. When you think about, even ordering something on an e-commerce site, you could have, up to 10 or more different applications touching that. MuleSoft serves as that connective layer to bridge those gaps, and really getting to that kind of automated enterprise isn't going to be possible without MuleSoft. And when you look at where Salesforce's vision is, that's exactly where they want to go, and that's why MuleSoft is so critical.
And we're showing a board here of sort of just explaining a little bit of the slowdown and some of the executive departures. Why the slowdown? Why are you hearing that?
When Salesforce first acquired MuleSoft, they started to really quickly pick apart some of the units, specifically IT and recruitment, and absorb it into, kind of the broader Salesforce ecosystem. Former employees say that really contributed to difficulty in hiring the kind of talent needed to both manage and maintain MuleSoft products as well as sell them. It's a very complicated sales motion, a lot harder than a standalone application that Salesforce is used to selling to customers. And so that kind of brain drain and the difficulty in hiring new talent has contributed or led to some of the difficulties that they're experiencing right now.
And Joe, it's interesting. It was a day sort of when we were looking at some of the big tech stocks that are some of the big outperformers. And I am curious, when you look at Salesforce, how the street and how investors are reacting to it, because they have their Dreamforce sort of event, if you will. And I have to say, looking at all the analysts, it's mostly positive. It's a lot of buys. It's a lot of outperforms. Has this yet sort of factored into the way analysts are thinking about it?
Yeah, in some ways, Salesforce is a victim of its own success. They've been such a solid growth company for so long, and any sort of weakness is going to immediately raise red flags. Analysts are split. Some think, this issue will be solved as soon as the existing quarter. Others think it'll take several quarters to fix. But it was definitely something, that did raise red flags, just given how important the unit is to the growth, and again, how successful Salesforce has been, really since its inception in producing pretty sizable, revenue growth and sales growth year over year.
Really appreciate it. Thanks for breaking it down for us. Bloomberg's Joe Williams. Back to those public markets, Getty goes. The provider of stock and news photos has agreed to merge with a blank check company backed by CC Capital and Neuberger Berman. The deal values Getty Images at about $4.8 billion, including debt. And coming up, stay with us. Apple rallies, posts its biggest weekly gains since July 2020. It's just shy, though, of that $3 trillion market valuation, 2.946, I think. Dan Ives of Wedbush, she's going to join us next to break it down. This is Bloomberg. Take a look at shares of Apple. Rose on Friday with the iPhone maker closing at another record, but it was just shy of that historic $3 trillion market valuation. Dan Ives of Wedbush joins us now. Dan, it's always so fun to get you on the program. And look, I have the excuse. I'm in the media. I like round numbers, so $3 trillion gets me excited. But you, as an analyst, looking at the fundamentals, does $3 trillion mean anything to you?
Look, I mean, I think we get there on Monday, probably Monday morning. Look, I think it's a watershed event, not just for Apple, but for the tech sector. In terms of what we're seeing with more and more flows to the likes of an Apple, I think it just shows this re-rating that's happening in tech, despite worries about Fed raising rates, 10-year. And I think this is really a theme going into 2022, that tech is going to continue to be that rock of Gibraltar with names like Apple leading the way. $3 trillion, definitely, I think, a seminal moment.
What happened this week? Because you had an incredible note that Apple hinted at some of the suppliers that there wouldn't be as much demand for the holiday season. But then you came out with a note and said that you felt like that had been a little bit overdone, and a lot of the reports about the slowdown maybe weren't as harsh as maybe your checks are showing. What are you seeing?
Well, first, I'll take a step back. I mean, reading the supply chain in this period of time, it's like a Rubik's Cube while you're blindfolded. So it's very difficult given the shortages and the ebbs and flows. But the one thing we continue to consistently see coming out of Asia checks is that demand's outstripping supply by roughly 15%. So when you look at supply, it could definitely hurt near-term numbers. And we saw that when Cook lowered guidance. But right now, that demand story, that's what the street's focused on, because you start to look into this next year, I think numbers are pretty conservative relative to what we're seeing. And then you look at services and some other sort of growth pillars. I think that's what's driving the stock higher. It's still one, I think many investors, they hated it at $1 trillion. At $2 trillion, they were screaming. And now at $3 trillion, they're continuing to just yell into an empty forest.
Yeah, they hated all the way on the way up. Another stock we could talk about is some of the haters out in full force is Tesla. And Dan, it was interesting when you think about Tesla. There was a note from a colleague of yours in the industry saying that if there was anyone that could do what Tesla does, it might be Rivian. How are you thinking about the competitive landscape of Tesla? Who's catching up to them? And is it Rivian? Is that the one to beat?
Yeah, and I think when you look at Rivian and you look what's happened in EVs, I don't view it necessarily as a zero-sum game, because this is going to be a $5 trillion green tidal wave, where I think Tesla is going to be about $2.5 trillion of that they're going to own. But then who owns the rest of the $2.5 trillion? Is that Ford, GM, Rivian, Lucid, and others? I think Rivian's in pole position when it comes to the SUV and pickup market. We spent a lot of time at the factory there in Normal, Illinois. And I think this is really going to be a household name when we go into the next few years as they execute. Today, the valuation, many investors will say it's way overvalued. See, I disagree, just because names like this, the transformational growth names, you got to look out 3, 4, 5 years. And I think what RJ's done at Rivian, the team, it's a real special story. And I believe this could ultimately be a $200 billion market cap.
Dan, we've talked a lot about the transformation of old tech to new tech. Oracle, I'm curious if that's maybe how you would have traditionally, a few years ago, classified as maybe an old tech player, but transition to the cloud. And is that a shift of how you're thinking about this, quote, new company, if you can?
Well, and I think ever since Nadella, what I would argue is probably the biggest transformation of a technology firm in the last 30 years, took Microsoft into the cloud behemoth today. Now, every investor is like, okay, who's next? And right, when you look at Oracle and what they're doing, they're laying the seeds of growth. This was definitely an inflection point quarter. And you can have a massive re-rating in Oracle. And I did say you can have a re-rating in names like IBM as well. Because as we go into 2022 in this cloud arms race, everyone knows about Microsoft and AWS. But who's number 3 and 4? And you look what Oracle has done. I mean, this is definitely a prove me quarter. That's why that stock continues to move higher. There could be a clear re-rating in this name over the next year.
You know, Dan, curveball here, and I do this because I know you can do it. I'm taking a look at your coverage universe, a lot of cybersecurity firms. I was just speaking with the former founder of Galleon Group, Rajaratnam, and he said that, of course, he can't manage outside money after the conviction of insider trading, but is managing his personal money. And he's looking at CrowdStrike, and he's calling it his biggest holding. How are you thinking about that cybersecurity space?
Well, cybersecurity, it's a golden age right now. I mean, when you think about cloud and you think about the threats facing enterprise and governments, it's still only 5% penetrated. You look at names like CrowdStrike, Zscaler, CyberArk, Tenable, and others. I think cybersecurity, in our opinion, is going to be the best performing subsector of tech going into the next, call it 6 to 9 months. So I truly also believe in these volatile periods, call it hand-holding. You know, this is really a name when you stress test numbers. I think Street's underestimating growth by 15 to 20%.
Really appreciate it. Dan Ives there of Wedbush. Always love when you can join us on a Friday. Give us some of that bigger picture perspective that you can always provide us. Really appreciate it. Coming up, we are going to hear from another big investor in this space, ARK Invest's Cathie Wood. She really talks about her long-term strategies and how to navigate these risk-off periods. We hear from her next. This is Bloomberg. Now, what should investors do in unusually long risk-off situations like the one we're in right now? My colleagues Romaine Bostic, Shanali Bassick, and we chatted with ARK's Cathie Wood to talk about her long-term strategy in times like these.
This risk-off period, which started in February and is still in force, is a very unusual one for us. I've never been in a market that is up, has appreciated, and our strategies are down. That has never happened before. And in fact, the disconnect is even more strange when I look at the up rounds taking place in the private world when it comes to innovation. Nubank comes out today. I think it had an up round this year that doubled.
Sorry for interrupting. Do you then change your strategy? If you've never seen this before, where there's an appreciation, but your strategy isn't working, do you change your strategy?
We have a 5-year investment time horizon. Our strategy is our strategy, and we believe that truth will win and in the end. So we think the opportunity in our strategy is huge right now. In fact, rarely in my career have I seen our 5-year projections for returns, compound annual returns, hit 40%. We believe, based on our estimates, now they could be wrong, we don't think so. We think we have the best research when it comes to innovation in the industry, very high degree of confidence as it is centered around Wright's Law, based on our very disciplined research. We expect a compound annual rate of return of roughly 40% over the next 5 years. That's a quadrupling. At the peak of our strategy in February, that number was 15%. That is our minimum hurdle rate of return. When we go through a period like this, of course, we're going through soul searching, saying, are we missing something? And we double down on our research and we double down on our modeling. What you should also know is to get to that 40% compound annual rate of return, we assume massive multiple compression from today's levels. If I can just finish,
Sure.
One of the reasons our multiples are so high right now is our companies are investing aggressively to capitalize on the 5 innovation platforms involving 14 technologies that we believe are going to scale exponentially during the next 5 years. And so we assume that the valuations are going to compress to FANG-like valuations. So it's a serious compression of multiples assumed, and we still get to that 40% compound annual rate of return.
Kathy, I'm really curious about the impact of higher interest rates. We've seen some of the growth names just generally really waver in anticipation of higher interest rates. I would love some specifics from you on how you think that some of your investments might be impacted.
Well, I think they already have been. I think that's what started in February once vaccinations were hitting critical mass, or we could see they were going to hit critical mass, and we were going to get back to work. I think everyone was working very hard, but back into the physical world. And so this assumption that the Fed was going to tighten started to make its way into the market. I think that's one reason many of our stocks are down. Some of them are down 50 to 60%. And what we see happening today is the flip side of, well, it's a little bit like what happened during the coronavirus. As we entered it, there were algorithms out there. And this market is, I think, controlled by algorithms in the short term. And so what happened in the short term as we went into the coronavirus is algorithms seized on 2 variables. How much cash do companies have? And are they burning cash? Those 2 variables took some of our stocks down 50, 60, 70%. And those who took those stocks down, the algorithms, the momentum players, the obvious trade, those people were all wrong. Those stocks were some of the biggest rebounders because, especially in the genomic space, the genomic revolution helped us get to that vaccine and to those tests much faster than what would otherwise have been the case. Today, what do we have? We have algorithms focused only on the valuations of stocks today, maybe trailing 12 or maybe this year, very short term. So they are thinking, okay, high interest rates, kill those stocks. So we think it's already taken place. And by the way, and I think, Taylor, you mentioned this earlier, interest rates, after Chairman Powell said, maybe this is not transitory inflation, the bond market rallied. And so I think the bond market is saying that that point of view is incorrect.
That was ARK Invest CEO and CIO, Kathy Wood. And coming up, we will be joined by Dfinity CEO Dominic Williams to talk about their latest network upgrade and what it means for the metaverse. That's coming up next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in New York. Let's get an update, of course, on those markets. Kriti Gupta, how did it go?
Yeah, let's just talk about the momentum play, Taylor, because one of the big kind of trademarks of 2020 was this idea that the NASDAQ 100 and the Russell 2000, well, they were trading together, and it wasn't because people were particularly confident in tech or particularly confident in small caps, but it was because of this thing called momentum, a factor strategy. And you kind of see it as the 2 indexes kind of move together. But lately, you've seen them diverge a little bit. The NASDAQ 100 actively outperforming the likes of the small cap index. The question is, does that relationship start to come together again? I want to move on over here and take a look at some of the other tech sectors that actually performed today, because you did see a broadly positive tech trade. At the top of the show, we talked about the information technology becoming 30% of the S&P 500. But here's what didn't get in on that trade. It's the NASDAQ Biotech Index. A lot of that has to do with Moderna and actually not getting the flu test results that they really wanted. So you can see really impacting the index, dragging it down as a whole, pulling it apart from that broader tech trade. And I want to end here with crypto, especially because, of course, we do see Bitcoin kind of hovering below 50,000, around 48,000. Let's just take a step back, and I want to pull us back to the November 9th peak here, a 28% drawdown in Bitcoin since then. A lot of people expected that perhaps this would pick up as we start to talk about an inflation hedge, see better CPI numbers, therefore a better bid in Bitcoin. But Taylor, it hasn't picked up by that same momentum, now just kind of hovering between its 100 and 200-day moving averages. Is that a technical sign that we might get some progress on over the weekend?
I blame Caroline. She took the day off, and she always tells me that Bitcoin is the new inflation hedge. So when she's out, let's just blame her for everything. Thank you, as always, there. Pretty good to have a great weekend. Let's stick with crypto, of course, and bring in our next guest, Dominic Williams, founder and CEO of Dfinity. So great to have you, and I think it's very late there. So thank you for staying up early for us. First, talk to us about this sort of Dfinity Foundation and what you're hoping to achieve with it.
Well, first of all, thank you for having me again, Taylor. I think we last spoke in 2018. So finally, the good news is the Internet Computer blockchain launched May this year. It's the first and only true world computer that runs hundreds of thousands of times more efficiently than traditional blockchains, so that you can actually use it to build anything without any use of the cloud. And I'm pleased to say that it's been working very well in production. There are more than 1,000 developers who've started building on the Internet Computer in the last 6 months. And so far it's proven very stable. And indeed, I think, Tuesday this week, AWS had an outage, and a lot of decentralized applications in the blockchain industry went down because they're built mainly on cloud and just interact with the blockchain on the back end. Not a single dApp built on the Internet Computer went down because they run entirely from the Internet Computer blockchain, which is a world computer, and it can even serve web.
Okay, so talk to us, because that outage certainly can make the case for having something run on that blockchain, but you're also talking about an upgrade, if you will, right? What does that achieve that we currently don't have?
Well, actually, the Internet Computer is constantly being upgraded. So one of the differences between the Internet Computer and traditional blockchains is that it's run, governed, managed, configured by a super advanced DAO, a decentralized autonomous organization. It's called the Network Nervous System. It has, I think, more than $10 billion total value locked inside, and many thousands of people participate in voting and adopting proposals which get automatically executed. These include proposals that actually upgrade the protocol. And as a consequence of this governance system, this DAO that controls the blockchain and can upgrade all of the node machines that host it, it evolves very rapidly. Recently, there was a very important upgrade that activated functionality that's important for people who want to blend DeFi with their services. So I think earlier on you mentioned the metaverse, for example. So in the metaverse, we're going to see the convergence of a lot of things. First of all, social media is already running on the Internet Computer. There's a chat app called Open Chat. And, the smart contracts on the Internet Computer are actually processing chat messages and storing images on the blockchain. That's social media, but that will soon sort of converge with DeFi. And, you're going to see things like chat accounts becoming, doubling as wallets, and, crypto being sent with chat messages, and chat being used to negotiate for assets and even do more traditional things like, notarize and sign documents. So, social media blends with DeFi, decentralized finance becomes SocialFi. Games do the same and become GameFi, and you've got play to earn and things like that. And both SocialFi and GameFi will converge in the metaverse. And all of this is possible on the Internet Computer without any cloud, because it's capable of storing and processing vast amounts of data. And in fact, it provides a complete alternative IT stack that's tamper-proof and unstoppable, and of course hosts advanced smart contract software that's capable of processing value and things like identity and code.
I just did a segment on the metaverse in Mars. So Dominic, to think that this can get more complicated, blink and it does. Let's take a step back and talk to us about earlier on in the segment right before you, how you're thinking about the use case of Bitcoin. We've talked about the use case of sort of that underlying blockchain technology in the ledger system, and the cases that you just made out really, I think, make sense for an average user and viewer. What about Bitcoin, though, on the massive volatility that we've seen, especially on days like today when it's not quite an inflation hedge? How does Bitcoin then fold into all of this?
Well, crypto markets are volatile. It's still a very new industry. I certainly wouldn't want to, criticize Bitcoin's volatility. We've experienced plenty of it ourselves. But we stay focused on the potential of the technology and working towards, growth. I mean, we believe that things like SocialFi and GameFi will bring in billions of users to blockchain. Actually, talking of upgrades, we touched on how the internet computer is constantly evolving. There's a planned upgrade that will be proposed to the governance system coming up, which will actually integrate the internet computer with Bitcoin. And what's going to be very interesting is that, smart contract code on the internet computer will actually get its own Bitcoin addresses. And when it moves Bitcoin around, it'll actually move on the Bitcoin blockchain. So in a way, Bitcoin's going to have, super advanced smart contract technology transplanted onto it. And, internet computer developers are going to benefit from the huge liquidity that the Bitcoin network brings. So I think that's an example of how, different networks can even combine in unexpected ways to generate new value. This space is still super early, and but that's why you're going to see volatility in the markets. Right. But it doesn't diminish the just huge potential of the technology involved.
I really appreciate it. Dominic Williams, of course, founder and CEO of Dfinity. It's complicated stuff, and you break it down so that average people like us can understand it. Really appreciate it. Coming up, it has already been a record year for investing in female-founded companies, but the numbers are still far from equal. Let's do it next with Lindsay Taylor-Wood, the founder and CEO of The Helm, where she says it is her job to make investing in women easy. That's next. This is Bloomberg. We know how much the pandemic impacted women-led businesses, but 2021 has seen a little bit of a turnaround in investments in female startups, with funding increasing to more than $40 billion so far this year. This is according to numbers by PitchBook. Much of that money invested in tech, healthcare, and retail. Joining me now, Lindsay Taylor-Wood. She is the founder and CEO and general partner of The Helm, which invests and supports female-founded companies. Really appreciate you, Lindsay, getting you on the program here. Talk about, sort of what a year 2021 was, the progress, but still maybe not quite short of parity.
Yeah, I mean, we're quite a ways from parity. I would say that while there may be incremental shifts that are moving in the right directions as it relates to investing in women, it's important to keep in mind that only 2.3% of venture capital goes to female-founded companies. And so we're really on a mission to change that and make it easy to invest in women through our venture fund and our angel network.
Where are you seeing the most opportunities right now? Is it technology?
Honestly, it's everywhere. I mean, I think it's really disrupting the idea that there's a pipeline problem. We have more deals than we know what to do with. We invest in early stage companies that are tech enabled. So for us, certainly we're really looking at tech as a place to see those big returns, but we're certainly not looking at a shortage of deals across industries. I think that women are hungry for capital, and we're finally at a point where there are more opportunities than there have been historically for them to be able to access it.
That's interesting because general in the PE world, we're hearing that there's a lot of cash chasing too few investments. Are you seeing the opposite, where there isn't enough cash going to all of the incredible opportunities that you just described?
I think it's a yes and. I mean, certainly it's a really interesting time to be in venture capital. There are an abundance of deals. Valuations are through the roof. Things are moving really quickly. And yet, to sort of insinuate that means that we're not facing the same types of bias that women and female founders have faced is just not the case. I still think that it's a tremendous hurdle for most women to raise capital in this climate. When they do, we're seeing higher valuations. Yes, we're seeing that rounds are oversubscribed, things are moving more quickly. But I would say by and large, one of the dangers of sort of playing into that narrative is there is a larger cultural conversation happening around investing in women, but I don't think we're seeing the capital match the conversation.
Talk to us about the conversation and how it has shifted this year. It's not lost on me that here at Bloomberg, we talk about the labor market and a lot of women not being able to come back into the labor force because there are still childcare issues, et cetera, you name it. How are you investing to help change that, given it is front and center in the narrative today?
So I would say that there are a lot of incredible companies that are looking at changing the dynamics of the care economy. And we have not invested in a company focused on that yet, but there are many incredible funds that are doing that work. The way that we're approaching it is to make sure that we really stand by what we believe need to be opportunities for women through our own company. So ensuring that pay is equitable, ensuring that women are being paid fairly, ensuring that there is paid leave, ensuring that, if you have a child or if you have a miscarriage, you're able to take the time that you need to take care of yourself. Having women at the helm, pun intended, of these companies is not just about the innovation itself, but also about the policies, the culture, the products that we're building, and how they're a response to the lack of support that we've seen thus far.
We're just coming off of a conversation about cryptocurrencies, and I am curious about some of the female founders within the crypto world. What are you noticing?
I mean, I have a theory that, women build very differently than men, and I think that we see that. So we know that women tend to care for communities. There is not, it's not lost on us that we're entering into an era where historically things haven't worked in the favor of everyone and only a select few. So I think when you see women and minorities enter the conversation, it makes sense that we're really seeing trends around democratizing access and decentralization, and those are key to Web3 and the future of crypto. And so I think we'll continue to see things that feel more communal and more about equal opportunity and access with women and minorities, part of a conversation that they've been locked out of historically.
It's interesting, Lindsay, because I'm reading a quote as well. And, a lot of your background is in philanthropy, and it says that men invested and women give their money away. Is that what is sort of the foundation of the narrative that you just described of building that community?
Yeah, I mean, it's a statement that always elicits a strong reaction. Usually, I think for the positive. Historically, women have been locked out of these rooms. We haven't had access to capital. We haven't had autonomy and agency over our own wealth. We haven't had opportunities to build wealth in the same ways. And that's beginning to change. And so as that continues to change, we need to think about the way that women approach their capital. Historically, our predominant relationship with our own capital has been around charitable giving. And what we're really encouraging women to do is come to the table in a different way, either as investors or as altruists. If you want to make impact, you can do that and also create a social return. And I would argue that in many ways, by investing in companies at the forefront of whatever the respective industry is that you're interested in changing, whether it be, access to sexual and reproductive health and rights or climate, you can find a company that is building towards that future so that your approach becomes much more proactive and not only retroactive, which is not to say that charitable giving isn't important. It's to say that it's going to require a more holistic response than what we've seen.
Where are you seeing a lot of the investment opportunities when you think about U.S. versus the rest of the world?
I think that women's healthcare, it continues to be one of the most exciting industries. We were really early to it. It's sort of reached a fever pitch, but we invested in a company called TIA, which just raised a $100 million Series B. They're really looking to reimagine women's healthcare so that you can go to one place to access all of your providers rather than having to go to a number of different physicians. We've invested in a company called UVA, who is disrupting at-home diagnostics tests, AOA, which is an early stage test able to identify ovarian cancer in its earliest stages. So we've invested in a number of women's healthcare companies, and we're seeing them come in droves. And that is extremely exciting. And I think one of the places where people can really look to see some big exits.
Lindsay Taylor Wood, founder and CEO of The Helm, really appreciate you joining us and giving us that perspective. We're following another story, and that is the president of Instacart leaving the company just after 3 months. Carolyn Everson announced that she's leaving at the end of the month and saying that it was, quote, the best decision for the company and for me personally. Everson previously worked at Facebook, now of course we know it as Meta, before joining that grocery delivery startup along with a number of her former colleagues at the company. Coming up, Blue Origin has been given a go for its flight Saturday morning. The launch will see the first NFL Hall of Famer go into space. More on that next. This is Bloomberg.
It was different in sports and football, but you see, we're in the training center right now. I'm here with my fellow astronauts, and we have been training so much, going through all the different protocols, all the different safety features, that you feel very confident, and we all feel very confident we can perform any function that we may need if called upon. And just all the different things, getting in and out of the seat, all these things that I never knew you needed to know. You just think you kind of get in, strap up, go up, come down.
We have a lot of people who signed up to go that will help us, pay the bills from developing the whole program over the last 18 years. But the team are now ratcheting up, building more spaceships, and once we have a number of spaceships and those people who can afford to pay a little bit more have paid it and have gone to space, then we'll start to be able to bring the price down. My grandchildren will definitely be able to afford to go to space, even if they weren't my grandchildren.
A good clarification there. Even if you are not a grandchild of Richard Branson, maybe one day you too will be able to afford it. That was, of course, Virgin Galactic, Richard Branson, of course. His thoughts on the future cost of space travel. Coming up Saturday morning, Blue Origin's next flight is slated for liftoff. For the first time, 6 people will fill the seats at the New Shepard, including former NFL player Michael Strahan and the daughter of Alan Shepard. It will mark the first time the spacecraft is at capacity. For more on the launch, I'm joined here by Bloomberg's Justin Bachman. And Justin, we've been speaking with you pretty much all day. We are really excited about this. I am curious, though, about the cost of that. When do you see it actually becoming commercially viable for normal, everyday people?
Well, I think those are two different things. Commercial viability is probably going to happen much sooner than affordability for most of us like you and me and what we can afford. I think for that latter part, you're talking about many, many years. 2030s most likely, if not longer, just because there are a lot of costs in this business. There are a lot of risks. And frankly, there's a lot of investment that these companies will want to recoup. They are not, rushing headlong into affordable tickets if the market demand is such that they can fly at, some elevated prices for an extended period and recoup some of the money that's been spent in building these companies. So I think that's an important factor to remember, that they all do want to bring it down to a level that we all could afford, but that's not going to happen anytime soon.
So talk to me about that competition, Virgin Galactic, Blue Origin, SpaceX. When do you see we get to the point where consumers maybe are looking at that as a differentiating factor?
Well, I think that's going to happen in the relative near term over the next 2-3 years. If these companies are both continuing to fly and following their current business models, they are really going to be, interested in differentiating their product. And you're going to have Blue Origin talk about how their vehicle is a completely different ride and profile compared to what you get, 300 miles away in New Mexico with Branson and Virgin Galactic, which is where you go up with a carrier aircraft and it's dropped, and then the rocket motor ignites. So you're going to see a lot of that. And then there's the experience and things that happen before your flight.
the training, the preparation, down to things like the champagne and the dinners, like who's serving what. That's probably what we're going to be, hearing about in the next couple of years as these companies ramp up.
Sounds eerily similar to commercial airlines. Very interesting, Justin Bachman. Thank you so much. And that does it for this edition of Bloomberg Technology. Time flies when you're having fun, I suppose. Stay with Bloomberg. My colleague David Weston, he's up next with Wall Street Week. I'm Taylor Riggs in New York. This is Bloomberg.